Choosing the right property for investment is not easy, so today I'm going to discuss several property types to avoid. The first type of property to avoid for investment is boutique or small developments. Boutique development typically has less than 50 units, while small development typically has between 51 to 150 units. These projects are often characterized by exclusivity, luxury finishes, or even good locations. Sometimes they are freehold. However, they have limited functional amenities such as swimming pool and a gym. And the reason why I do not recommend these types of properties for investment is because although you might be able to rent them out fairly easily, you might have a much harder time trying to sell them off. Why? With fewer units in the development, this means you don't have a lot of historical transactions to benchmark the price with. The second reason is higher maintenance fees. Smaller developments mean you have fewer people to share the cost of common area maintenance, which can lead to higher maintenance fees. This can eat into your rental income and also a turnoff for potential buyers. Compared to larger developments, boutique condos or small developments may have fewer or less impressive amenities. This can make them less attractive to tenants and buyers, impacting rents and resale value. The last point is because it's not en bloc potential. With boutique or smaller developments, typically the land is small. Hence, it's not appealing for developers to even start an en bloc discussion. The second type of property I don't recommend for investment would be high-end condos in the CBD area. Although owning a private property in a central area can seem like a prestige, it might not be the best investment. Why? Number one is because of the high entry price point. This means a larger initial investment potentially requiring high loan amounts and hefty interest payments. If for any reason you need to sell quickly and the market happens to be in a downturn, then you can lose money. The next reason is because higher foreigners ABSD. With 60% ABSD, we can no longer expect foreigners to buy private properties in prime districts. This leaves you with a very small pool of buyers, which means it's going to be very difficult to sell the condo. The other reason is rental price limitation. Although technically as a landlord, you can ask whatever amount you want, renters have their own budget limitations. With more foreigners on a local package and no longer receiving housing support, you might need to lower your asking price for rental in order to remain compelling. But will it still cover your mortgage, maintenance fees, and other expenses if your condo is so expensive to begin with? That is something that you will have to calculate. The third type of property that's risky for investment is older 99-year leasehold condos. When I say older, I think about 20 years plus is yellow light already. Why? Because if let's say you are going to hold the property for 7 to 10 years, that will mean the property will be 30 plus years old when you are trying to sell it off, and with it not being a freehold, it will for sure turn off a lot of buyers. Why? As the remaining lease period shrinks, so does the property's market value. Banks may also offer lower loan-to-value ratios for older condos, making it harder for buyers to finance their purchase, further impacting demand and price. CPF usage for older properties also have more limitation. Besides, the renovation and maintenance for older properties are typically more costly as well. Another thing you should consider is the psychological factors. Some buyers may want to seek long-term stability for their family home, or they dream of inheriting the unit to their child. In such cases, they would prefer freehold or newer leasehold properties due to the perception of greater security and long-term value. All of these factors eventually reducing your pool of potential buyers. The only exception I can think of is if the condo got a good chance to get en bloc. The telltale sign is usually if the location is very good and the plot to land ratio is relatively low. This means a developer can come in, buy the development and basically build more units to make a profit. But en bloc is not something you can count on, so I suggest passing older condos unless it's for your own stay and not for investment. The next type of property that can be a hit or miss for investment would be mixed development projects. Mixed development, if it's in a good location, managed properly, and has a good set of anchor tenants, can be a very attractive feature for future buyers and renters. However, if it's a small mixed development project and it's not managed properly, it can quickly be an extra burden for the residential owners. This is because the maintenance fee for the commercial space is surprisingly being billed to the homeowners. Another challenge that you might encounter is the noise level, because there are more commotions under your residence. If you are interested in a mixed development, there are things that you can check to make it less risky investment. Number one, make sure you check the number of units. Ideally, it should be a large or mega projects with more than 400 units. Second of all, the location should be good, meaning it's within walking distance or even above an MRT station. The third point is that check who will manage the commercial space later on and check their reputation. If you never even heard of them, forget it. The next point is that check whether the developer has set aside a separate entrance for the residents, because if the entrance is mixed between the public and residents, then you will have to queue longer at the parking lot just to get home. The next property I don't recommend for investment is any condo on the second floor. In general, flats that are located on level 4 or lower are harder to sell. But second floor is extremely difficult to sell. Even if you can sell it off, usually it will be significantly lower price than your neighbors on a higher floor. There are several reasons why second floor units can be harder to sell compared to those on higher floor. The first reason would be less privacy. Being closer to the ground, second floor units might have less privacy than higher floors. People passing by could see into the windows, especially if your window is not tinted and is not covered by trees or any other barriers. The next one is that because of noise and smell from common areas, you can't control what people are doing on the ground, so they can be smoking, barbecuing, running around, jumping to the pool, etc. And the second floor unit will be heavily impacted by this. Some newer condos nowadays have their garbage disposal area in the basement, but if it's at the ground level, it will definitely be an additional turnoff for potential buyers. So do yourself a favor and just pay a bit more to buy units on higher floors. Avoid units at level 2 to 4 as much as possible. A more value for money unit would be those located at mid-level, so between level 6 to 10. It's not so low that it pushes people away, but it's not so high that the entry price point is more manageable. Last but not least, unless you have an extensive knowledge or live there for a long time, I do not recommend buying overseas properties. Without naming names to avoid defamation, I'm sure you also know there are several gurus who are promoting buying foreign properties. But this is a very high-risk business, especially if you are not familiar with the legal systems, property regulations, and cultural nuances. For example, this house in the United States is on sale for $1. Yes, $1. Even cheaper than curry puff. However, there are a lot of red flags. First of all, the condition of the house basically requires you to demolish and rebuild from scratch. Second of all, the area where the house is located is problematic to say the least. If you think about it, if it's such a good deal, wouldn't the locals flock to it and leave no chance for foreigners like you and me? Other than that, the currency exchange rate fluctuation can significantly impact your investment returns. If you want to exit, selling an overseas property might be difficult than selling locally, especially during market downturns. And if you want to keep and rent it out, maintaining an overseas property can be very challenging, especially if you are not physically present. Managing repairs, finding tenants, and dealing with local regulations can be time-consuming and costly. Don't forget to subscribe for more property and personal finance tips, and I'll see you on my next video. Bye-bye!